Hi, I'm Dustin Saldarriaga, an immigration lawyer with Scott Legal PC in New York City. In this video, we're continuing our series on U.S. tax law as it applies to foreign nationals visiting the United States by taking a look at how the IRS taxes resident and non-resident aliens. In earlier videos, we discussed how spending a certain amount of time inside the U.S. is all that's needed for a foreign national to be characterized as a resident alien, which then exposes their worldwide income to taxation by the U.S. government. But what about non-resident aliens? How are they taxed? As we'll see, a lot comes down to the definition of U.S. source income. Before we get started, please remember that the information in this video is not legal advice. We strongly recommend that you work with a qualified tax professional who can guide you through the specifics of your circumstances. Tax law is complicated, and a qualified professional can be a critical resource. So let's dive in. In an earlier video, we discussed how the Internal Revenue Service, or IRS, characterizes those inside the U.S. who are not U.S. citizens as either non-resident aliens or resident aliens for tax purposes. Remember that the terms resident alien and non-resident alien, as used by the IRS, are tax terms, not immigration terms. The IRS uses the green card test and the substantial presence test to determine whether a foreign national visiting the U.S. is a resident or a non-resident alien for tax purposes. As we discussed in our earlier video, a foreign national visiting the U.S. is a resident alien for tax purposes if they meet either the green card or the substantial presence test, meaning that those visiting the U.S. do not need a green card in order to face significant tax consequences. But what are those tax consequences? Resident aliens are largely taxed in the same way as U.S. citizens, meaning that their worldwide income is subject to U.S. tax. They must report to the IRS all dividends, interest, wages, salaries, income from rental properties, and any other income, whether or not it originated from within the U.S. Resident aliens are subject to the same graduated tax rates that also apply to U.S. citizens. The graduated tax rates can be found in the instructions for the IRS Form 1040, which we'll link to below. Resident aliens might be eligible for certain exclusions from their gross income. If over a consecutive 12-month period they're physically present in a foreign country for at least 330 full days, the resident alien could qualify for the foreign earned income exclusion. The exclusion was $108,700 in 2021. Additionally, a resident alien might be able to exclude or deduct certain foreign housing amounts. Finally, if a resident alien is a national of a country that has an income tax treaty with the United States, the resident alien might qualify for an exclusion based on that treaty. For all of these circumstances, it's worth speaking with a qualified tax expert about your specific scenario. And what about non-resident aliens? How are they taxed? While resident aliens are taxed on their worldwide income, non-resident aliens are typically taxed only on income they receive from sources within the United States or from trade or business conducted in the United States. In this video, we call this U.S. source income. To determine their tax burden, a non-resident alien will want to first figure out what portion of their income is U.S. source income. The rules for determining whether a source of income is U.S. source income are different depending on what the source of the income is. For example, whether the income is from interest, dividends, wages, or salary, rents, a property sale, or another source. In this video, we'll touch on a few of the most common categories of income and how to determine whether each is U.S. source income. Please note that there are exceptions within each of the categories we'll discuss. As a result, again, please do consult a qualified tax professional to determine whether and how these exceptions apply to you. First, let's take a look at interest. In general, the source of interest income is determined by the residence of the entity paying the interest. Interest on bonds, notes, or other obligations of U.S. residents or domestic corporations in the United States would be considered U.S. source income, as would interest paid by a domestic or foreign partnership or foreign corporation that's engaged in a U.S. trade or business at any time during the tax year. Also, interest from a U.S. state, the District of Columbia, or the U.S. government would be U.S. source income. The rule is similar for dividends. In general, the source of dividend income is determined by whether the corporation paying the dividend is a domestic corporation, in which case the dividend is U.S. source income, or is a foreign corporation, in which case the dividend is foreign source income. To determine whether income from real property, meaning property that's tied to land like a building, is U.S. source income, you would generally look at where the property is located. Income from a rental property is U.S. source income if the property is located in the United States. Similarly, income from the sale of real property is generally considered to be U.S. source income if the property is located in the United States. Income from the sale of personal property is treated differently from real property, in part because personal property, like furniture, machines, and equipment, is usually mobile. Income from personal property is considered to be U.S. source income if the foreign national has a tax home in the United States. A tax home is where the foreign national permanently works as an employee or as a self-employed individual. If the foreign national does not have a main place of work or business, the tax home is the place where they usually live. If the foreign national has a tax home in the United States, income from the sale of personal property is generally U.S. source income. If they do not have a tax home in the U.S., income from personal property is generally foreign source income. What about income earned from work or personal services? In general, any compensation, including a salary or wages, that's received from services that were performed in the United States is U.S. source income. If you receive compensation for work performed both inside and outside the United States, you'd compute the proportion of your compensation that's U.S. source income by using what the IRS calls the time basis formula. The time basis formula is also used in cases of self-employment. The time basis formula requires that you divide the number of days you worked within the United States during the year by the total number of days you worked during that year. You then multiply that number by your total compensation during the same time period. For example, Alex, a resident of Colombia, worked 240 days for a U.S. company during the year and earned a total of $100,000 for his work. Of these 240 days, he worked within the U.S. for 60 days and in Colombia for the remaining 180 days. To compute Alex's U.S. source income, he'd first divide the number of days he worked in the U.S., 60 days, by the total number of days he worked, 240 days. This results in 0.25. Next, Alex would multiply 0.25 by his total compensation for the year, $100,000. This results in $25,000 in U.S. source income. Speaking of work, what about fringe benefits like housing, transportation, or meals? How are those taxed for non-resident aliens? First, fringe benefits would be excluded from the time basis formula we looked at before. You would not include their value when computing your total compensation. To compute the value of any fringe benefits that are U.S. source income, you would apply the geographical basis test. This looks at the location of your principal place of work, meaning the place where you spend most of your time at work. For example, if Alex spends most of his time at work in Colombia, the geographical basis test would suggest that his fringe benefits are generally not U.S. source income. So, you've figured out how much of your income is U.S. source income. How do you figure out what tax rate will apply to that income? Once you've determined what part of your income is U.S. source income, the next step is to figure out whether the U.S. source income is effectively connected with a U.S. trade or business. If the income is effectively connected with a U.S. trade or business, it's generally taxed at the graduated tax rates that also apply to U.S. citizens and resident aliens. As mentioned before, the graduated tax rates can be found in the instructions for the IRS Form 1040, which is linked to below. If the U.S. source income is not effectively connected with a U.S. trade or business, it's generally taxed at a flat 30% rate, or at a lower rate if there's a relevant tax treaty. The flat 30% rate can apply, for example, to fixed income, which can include interest, dividends, and certain compensation. For a specific estimate, be sure to work with a qualified tax professional. We hope this video was helpful, and if it was, please click the like and subscribe buttons below to stay updated on future videos about visa options and travel to the US. Thank you for watching.